home equity line of credit, HELOC, is a financial product that allows homeowners to borrow against the equity they have in their homes. Equity is the difference between the market value of the home and the outstanding mortgage balance. Here's how a HELOC generally works. Collateral. The home serves as collateral for the line of credit. If the borrower fails to repay, the lender can foreclose on the property. Revolving credit. Similar to a credit card, a HELOC is a form of revolving credit. You are approved for a certain amount, and you can borrow as much or as little as you need, up to the approved limit during a set period, typically 5-10 years. Draw period and repayment period. The HELOC usually has two phases. The draw period is when you can access the funds and typically lasts around 5-10 years. During this time, you might make interest-only payments. After the draw period, the repayment period begins, where you can no longer borrow, and you must start repaying the principal and interest. Interest rates. HELOCs often have variable interest rates, meaning the interest rate can change based on fluctuations in the market. Some may offer fixed-rate options for a portion of the loan. Flexible use of funds. Borrowers can use HELOC funds for various purposes, such as home improvements, debt consolidation, education expenses, or other major expenses. Minimum payments. During the draw period, you may be required to make minimum payments. These payments usually cover the interest charges. Credit limit. The credit limit is determined based on factors like the home's value, the mortgage balance, and the borrower's creditworthiness. It's crucial for borrowers to understand the terms, including interest rates, fees, and repayment requirements, before getting a HELOC. Additionally, using a HELOC responsibly is important to avoid the risk of losing your home through foreclosure if you can't meet the repayment terms. Should you get a HELOC? Here are the pros and cons. Pros of home equity line of credit, HELOC. Lower interest rates. HELOCs often have lower interest rates compared to credit cards and personal loans. Flexible use of funds. Borrowers can use the funds for various purposes like home improvements, debt consolidation, or education expenses. Potential tax deductions. In some cases, the interest paid on a HELOC may be tax deductible, especially if the funds are used for home improvements. However, tax laws can change, and individual circumstances vary. Revolving credit. Similar to a credit card, a HELOC is a form of revolving credit, allowing borrowers to access funds as needed. Access to large amounts. Depending on the equity in the home, HELOCs can provide access to substantial amounts of money. Flexible repayment terms. During the draw period, borrowers may make interest-only payments, providing flexibility in managing cash flow. Build home equity. Homeowners can use HELOC funds to increase the value of their homes, potentially building more equity over time. Quick access to funds. Once approved, borrowers can quickly access funds as needed without going through an extensive application process. Competitive market. Due to competition among lenders, borrowers may find competitive interest rates and terms for HELOCs. Emergency fund. HELOCs can serve as a financial safety net in emergencies, providing quick access to funds. Cons of home equity line of credit, HELOC. Risk of foreclosure. Failure to repay a HELOC could result in the foreclosure of your home, as it serves as collateral. Variable interest rates. Many HELOCs have variable interest rates, making monthly payments unpredictable if interest rates rise. Fees and closing costs. Borrowers may incur fees and closing costs, including appraisal fees and annual fees, which can add to the overall cost. Market fluctuations. Changes in the housing market can affect the available equity and impact the terms of the HELOC. Complex terms. The terms of HELOCs can be complex, and borrowers need a clear understanding of draw periods, repayment periods, and interest calculations. Potential for overborrowing. Easy access to funds can lead to overborrowing, potentially putting borrowers in a challenging financial situation. Credit score. Impact. Opening a HELOC can impact credit scores, especially if the borrower uses a significant portion of the available credit. Limited fixed-rate options. While some HELOCs offer fixed-rate options, the majority have variable rates, exposing borrowers to interest rate fluctuations. Interest-only payments. During the draw period, making only interest payments means the principal balance remains unchanged, potentially leading to higher payments during the repayment period. Market value fluctuations. A decline in the market value of your home could reduce the available equity, affecting the amount you can borrow.